Well, welcome everyone to the Principal Wealth webinar for August of 2024. It is titled Rotation. My name is Julina Ogilvie, partner and wealth advisor here at the firm, joined by our founder and CEO, Bob Paolucci. Bob, welcome back.
Hi, I think we should have called this one There's a Lot Going On.
Yeah, so you're jumping into it already. I love it. So we actually had our last webinar 30 days ago. And I will say, if you did not listen to it, we conveyed fairly aggressively that there were a lot of key decisions that needed to take place over the next 120 days. So we're now 30 days later, and man, we have seen a lot. So I know we're going to review all this, but in case you've been on vacation or anything, just a couple key areas here. There has been an elevated fear of a recession. We did have a president withdraw from the election. We had an attempted assassination of a former president. We've had global elections, global volatility, disappointment with Fed's key rate decisions. And now that's transpired into some recent volatility here in the US. And we still have some key decisions that need to be made. So we thought we would circle back and update everyone on where we are. We're going to do that with three key areas on our agenda. We're going to talk about the markets, the economy and policy, and then we're going to talk about everything else that you're hearing from in the media. Is that fair?
It sounds like a wonderful video we're going to have here. A lot of work to do. Yeah, so that's fair. So a few things we'll point out. Change happens fast, right? So we're going to take a quick look at and a quick look back at maybe the past month and a half or so around big cap stocks, small cap stocks, bonds. Japan had a few bad days, and they seem to have exported some volatility to us. We'll get into that. We'll talk about key market levels. We will talk about all the Fed data that they seem to not be paying attention to. We'll talk about how you lose control of the narrative. We'll talk about some of the other stuff that's in the financial news, like really what happened yesterday, Monday, in Japan that found its way over to the U.S. So with that, let's jump in.
Yeah, let's jump in. We're going to start with the S&P, but there's so much more that transpired that maybe clients might not have noticed.
Yeah, so this is going back to July 1st. We ran this chart, right? And what we did is we wanted to show the drawdown from the high for various securities. So you have the Magnificent Seven. We added another to make it eight, I believe, two, four, six, eight. And that is Tesla, Alphabet, Amazon, Meta, Nvidia, Apple, Microsoft. So they're all down, in aggregate, probably about an 18% weighted decline. But the S&P 500, all glued together with the other 490 some odd components, is down 8.5% off of its high. Not too bad. Said in a different way, all of these stocks are still significantly positive for the year, and so is the S&P 500 to the tune of about 9%. So it was a cool off that was really driven by some delevering that we're going to go into in just a moment.
Yeah. And what's interesting too, we're not getting as many questions from clients on this part of the market, but the bond market changed quickly as well.
If you want to see a bigger change, it's in yields. And this is what happens when the Fed loses their narrative, loses the trust of the bond market, right? I don't really know who's more powerful. It's debatable whether it's the bond market and all the money that goes into it, betting on the direction of rates, or the Fed, who controls overnight rates. Historically, it has been the market, the bond market, that is more powerful, right? There's even a term for the key investors that control the bond market. It's called the bond vigilantes. You may have heard about that. And, I think the bond market is right. And what happened here is since the Fed meeting a week ago, you've seen the 1 year treasury, 2 year, 3 year, 5 year, 7 year, 10 year decline significantly. The visual on the bottom chart, the light blue line and the purple line, that is 1 week apart. And what you see is a week ago, the blue line, you had yields, it's really a month apart, but yields were exactly the same a week ago. You had yields significantly higher throughout the yield curve. And then you had a massive change on Thursday after the Fed meeting, Friday, a little into the weekend using futures contracts. And then on Monday, yesterday, it was a combination of some stuff went haywire in Japan, number one. Number two, the bond market is just saying, yeah, and the Fed was wrong. They should have cut rates already. All of a sudden, though, they move yields down. So when you look at the 2 year and the 3 year, the yield has dropped by almost 20%. That is, it's hard to articulate, but that's like a year or two or a full cycle's worth of movement in yields. This
And Bob,
happened.
isn't it fair to say that most investors that have been investing in the bond market have been centered around that area in terms of maturity?
Yeah, and this is a good thing, right? Because your bond
Yep.
prices have gone up. So if you looked at your investments when stocks are going down, well, your bonds are going up quite well.
Mhm.
And when you look at returns for these various maturities, you really had a 30-day return of the 10 year of about 6%.
Right.
That's a year and a half, almost a year and a half worth of price movement. So thankfully, we have exposure to some bonds. We swapped out for some yesterday, some long-term bond exposure, but bonds have made a comeback. They went from, zero total return halfway through the year to getting about a year and a half worth of return in 30 days. How about that?
Yeah. And I
Change
just think
happened
it's so
fast.
interesting that more of the trading that we did at the firm based off the volatility was really on the bond side
And the
over the
bond
stock
side.
side.
Yeah.
Yeah.
Yeah, that's right.
So thank you
Yep.
for pointing that out.
Yep.
And what about the yield curve in general?
Yeah. So the yield curve, our clients may have heard about an inverted yield curve, right? We had this yield curve inversion. What that means is short-term rates are higher than long-term rates. And really what they're measuring is the 2 year treasury versus the 10 year. Generally speaking, if you buy a bond or you borrow money, which is really what a bond is, you should expect to have to pay more when you borrow for longer.
Mhm.
And if you're on the other side of that exchange, you should expect to get a higher coupon, more interest, the longer you lend, right? So we've had this inverted yield curve, which the only reason why we're bringing it up is it's usually a good predictor of recessions, or it has been for a very long period of time. I would say one thing is a little different this go round. The reason for the inversion has little to do with economic stress and bank lending and all that stuff. It has to do with the Fed having rates artificially too high,
Mhm.
which usually doesn't happen, right?
Yeah.
So the reason why the 2 year is so high is because it is much closer to the rate that the Fed controls, and the Fed has rates really, really, really high in restrictive territory. Soon, very soon, they're going to be cutting to a much more normal level.
Mhm.
And now the bond market is starting to price that in, if that makes sense.
It does, and I was also going to suggest that even if you are a believer that this is very indicative of a recession because the media loves to talk about this, if you've heard us talk about in these past webinars, we've already suggested that we believed we went through a rolling recession last year. They just never officially were able to name it one.
Yeah. Yeah. It's just about 2 years ago, right? So in
Two, yeah.
the first and second quarter of 2022,
Mhm.
we had two consecutive quarters of negative GDP growth, and we had most of the signals that you measure to call a recession were flashing red. The only one that wasn't was the unemployment level. It was going down instead of going up. Typically, when the unemployment level rises pretty substantially, almost that alone creates a recession. It was going down because the world was reopening.
Yeah.
I mean, it doesn't mean we weren't in a recession. We were. The economic data was saying it. It just wasn't called. So we believe we already had that recession, and the yield curve was right. We think the inversion more recently over the past year and a half has been due to the Fed manipulating short-term interest rates. So, anywho, the yield curve inversion has been flattened. It ended after 758 days, the longest stretch, longest period of time ever, where we've had an inverted yield curve. Again, that's how long the Fed has had this stronghold on short-term rates.
Why we've been talking about the Fed for so long.
That's right. Yep.
One other change was really in the small cap space.
Yeah, so we were talking about, it's a good time to start to nibble on some small caps, and we kept nibbling and we kept talking about it, kept talking about it. We also said, look, it's small caps. They're not widely invested in like mega cap companies are. It's a smaller part of the market. It's oftentimes forgotten about, but it's a very valuable part of the market that historically performs very well when we come out of a high rate environment and we go into a neutral to low rate environment. And we've had all the data backing up the likelihood of a lower rate environment coming, but small caps don't react until there's actual language around the Fed saying, yes, we're going to do something, or there's action that involves lowering of interest rates. So for the entire year up until July 9th, small caps, they had a return of zero, generally speaking, right?
Mm-hmm.
And then in 4 days, they had about a 10% return. So there are some asset classes that you just have to own,
Yeah.
knowing that there will be return and there is opportunity, not exactly being able to pinpoint exactly when you'll get that return. Um, Returns in small caps happen in small, short clusters, right? So I fully expect
Don't
small
blink.
to go to sleep for about another 90 days, whether or not there's good or bad information. And then they'll probably wake up again for 3 days and then hibernate again. That is just the return profile of some of these asset classes, which is why, risk management and knowing what the right ratio is, and diversification is the right thing to do. You can't overweight small cap, um, because it'll make you feel like a fool, and then all of a sudden you're a genius. That's never the case. These are decent asset classes to invest in. You do just have to be patient. So we're happy to say that we finally got some really good returns quickly in small cap.
Yeah, which is
Yeah.
fantastic.
Yeah.
So there were clearly a lot of areas of the market that were affected over the last few days. And I think to address why this occurred, we're gonna start with Japan.
Yeah. You think we had a few bad days in the market. How about Japan? They had the biggest 2 day drop in history. Just on Monday, their market went down 12.4%. That sticks out. But the prior day doesn't.
Yeah.
It was bad, but it wasn't a 12.4 decline. It was, about half as bad. So almost a 20% decline, just about a 20% decline in 2 days, is wild. Now, remember, different time zone, different market, that creates margin calls, and some of that spilled over to the US. And again, we're not going to talk about it just yet because we have an image that we're going to show you that sort of defines what happened. But there was a lot of bad market mojo that found its way into the US on Monday from the collapse in Japan on Friday through the weekend into Monday as well.
Yeah. To your point, before we talk about the why we're talking about Japan, let's maybe address a few things in the US market and then dive into that.
Yeah, we'll pause on Japan for a second and tell you that there are things that we look at in the market that really tell us um, some of the direction that could be coming in the market and at what intervals we would want to step in rebalance portfolios or buy stuff on sale. And those can be seen for those playing at home through the moving averages of the S&P 500, right? Big, broad, good representation index that is widely invested in. It's very liquid. That's what you want to use. You don't want to use obscure stuff that's way too volatile. So when you look at the S&P 500, there are key moving averages, right? Trends. And what we see and what we really look at is the 50-day moving average, the 150-day intermediate moving average, and the 200-day. We look at others, but those are the main ones. And that tells us usually where the floor is if there's selling. Is it perfect? No, but it's pretty good. So we see here that if we want to plan for more downside and we want to get ready here at Principal Wealth for buying some stuff, we're looking at the 200-day moving average saying that it is currently at about 5,012. So 5012. So what we do is we do some quick calculations based on the securities that we own, the indexes that we invest in, so on and so forth. And we say, all right, it would be nice to buy this 5% off, 7% off, 10% off, 12% off, 15% off, so on and so forth. That's how this helps us come up with some of those ranges. Right now, the sale is not big enough for us to get too interested. Again, we dabbled with some fixed income yesterday for some clients. We're looking for bigger sales to deploy more capital, and we don't think this will end up being a bigger sale. But to tell our clients listening to this, if the market declines a little bit more, it probably has likely at max, not perfect, don't hold me to this, but up to maybe 4.5% more to go before there's a tremendous amount of buying back that happens in the market. So will it get there? Probably not. Could it get there? Sure. If it does, we might be buyers of it as well. So
Yeah, and I don't think it's very often we show these technical slides, but when we get into why we think this transpired over the last few days, I think it's going to be important to kind of come back to this visual, if that makes sense.
yeah, I think it's helpful. I mean, there are literally 47 other indicators and things that we look at that help us make the really good decisions that we make. This is one of the easy ones that gives you
Okay.
some color.
Yep. And another one that we're always looking at, we always talk about because it's so important, is earnings.
Yeah, so for those that were saying, whining that the market was too expensive a month ago, 2 months ago, 3 months ago, well, it's cheap now. You had earnings continue to go up. You would think with this sell-off that earnings were down. They weren't. Companies were guiding future earnings down a little bit. This way, next quarter and the quarter after, they can easily jump over the bar that they set for themselves. I think Wall Street was getting a little too frothy with their expectations that earnings would go to the moon. Yeah, they're going to be higher, but they're not going to go to the moon. So a lot of these companies said, hey, take your expectations down from the moon down to a level where I could jump over that hurdle.
Right.
So some of the analysts were disappointed, but earnings were up, not down. So what happens when earnings get reported higher and prices come down? Well, the market goes on sale from a valuation standpoint. So the PE ratio of the S&P, which got to let's see if I read this chart correctly, which got to about 22, is now sitting at about 20.
Right.
So the market is now 10% cheaper from a valuation standpoint. And that's also the case for small and mid cap. And it's not because they went down, it's because earnings popped, right, Julina?
Right. Yeah.
Yeah. And I think one of the blurbs you had mentioned, you read something about small caps having this in aggregate.
Oh, sorry, not small caps. The take out the Magnificent Seven, the 493 names in the S&P.
Yeah.
For the first time since 2022, they are now expected to have positive earnings growth of 5.7%.
Yeah. So the smaller cap, the average
Smaller,
cap
yes.
stock, yeah, the
Yep.
average cap stock is now joining the party.
Yes, which
Yeah.
we also talked about in the last webinar about the fact that the concentration of the return of the Magnificent Seven was not sustainable.
You bet we're going to pat our backs.
Yeah. So let's transition back to Japan and talk about what transpired.
All right. So long story short, there was a surprise move, right? Some of these extremes are because there are decisions or actions that weren't expected that happen. And sometimes a lot of money is not positioned for that unexpected move, right? And last week into yesterday is a perfect example of this. Long story short, Japan still has zero interest rates, right? They have no inflation. They've been at zero interest rates for a very long period of time, over a decade. And through a change in regulation here in the United States over the past 20 years, there are some limits to how much leverage you can put on if you're a big institution or a private institution. So leave it to those institutions to find loopholes. And the loophole that they found was we can get a ton of leverage if we go to Japan, borrow money at zero, lever up, borrow a ton of money, use our investments as collateral, and invest those proceeds into more investments here in the United States, specifically technology, S&P 500, even bonds, right? Think about this. If you borrow from Japan at zero, you can take the proceeds, put them in a money market with us, and make a 5% spread.
Right.
right? Or just about 5%. You could still do that today.
Mhm.
Do we advise that? Absolutely not, because there's leverage, there's risk. That loophole can change pretty quickly, and it just did. So we believe, I should say we know, but we're going to go with we believe that there was a ton of this happening by maybe just a handful of hedge funds where they were borrowing tons of money, levering up, borrowing tons of money, investing it here in the United States. Why do they invest in the United States? Because there's growth here, there's higher yields, and it is the world's piggy bank. It is the capital markets of the United States of America that is the piggy bank of the world. You can put $1 trillion in today and pull it out tomorrow, right? You cannot do that in the South American stock market. It would disintegrate. You can't do that in the European markets. You can't do that in China. They'll just keep your money and say that you can't get it. But here in the States, we allow all the money to come in and all the money to go out on a liquid basis very quickly. So all this money, the proceeds, find their way here. And that's what has happened for some time.
Mhm.
This trade has existed now since rates in the US have been above zero, since there's been a spread between Japan and here. And suddenly that opportunity disintegrated in 2 to 3 days last week. What happened was the Japanese yen um, was declining. It reached the 38-year low over the past couple of weeks. Because of that, Japan was figuring out what to do. Their currency can't keep getting devalued. So they did this wild surprise rate hike. The Fed in the US, they don't surprise anybody, right? They're just late to the party all the time. In Japan, they said, hey, let's huddle up really quick and go public with a rate hike, which it was only a quarter, but when it's off of zero, the relative change from nothing to just above nothing
Right.
created a storm because the currency strengthened significantly quickly. And the opportunity in that carry trade, borrow at zero in Japan and make something in the US, went away because now you owe more yen, a lot more quickly.
Right.
So what happens? Well, if you're borrowing money and you're upside down in the trade, the banks who are holding your assets and the trade for you, they sell securities when they want to. And they also sell whatever they want. It doesn't matter what you want. They go into your account and they sell everything and anything they want until there's no risk to them anymore. You could still have risk, but they don't want to have any anymore. So that is what happened on Friday through the weekend and Monday. A lot of it rolled into our markets, right? It was like a snowball that found its way into our markets. As recent as last week, there was still a pretty good levered opportunity to do this. And today, there's no opportunity. And it created a ton of losses. And, they made a mistake, a handful of hedge funds, and we all paid the price through our liquid markets for their mistake. This should be illegal, but it's completely legal. There needs to be some regulation and some leverage limits set for these private institutions. But again, because they're private, there's really no regulatory oversight or very minimal oversight. But here is exactly what happened. And when you have the emotional sell off in the market, right? Oh my God, what happened? Nothing. Earnings are up. Yeah, the Fed made a blunder, but in 60 days, they're going to cut rates. It was this. When this happens, you start to hear things like maybe it's because Warren Buffett sold Apple last quarter. No, it's nonsense, right? That happened last quarter. Maybe it's because everyone's upset with the Fed. Yeah, I'll give you that. Maybe it's because the Trump trade is being priced out a little bit. It could be a part of that. Maybe it's because, Hezbollah invaded Israel. It's certainly some of that. But all of those things get glued together and blamed when there's an event like this. But I can tell you this was the event, plain and simple.
And Bob, there's a lot of numbers on this page, but what you're referencing as an example is last week, if you were one of the larger trades, right? You look at the borrowing rate and then what the treasury yield as an example is the investment plus the currency carry. you were looking at almost a 12% return versus this week, now all of a sudden, that same larger trade, you're looking at almost a 6% loss.
That's that's with $1.
Yes.
That's unlevered. When you add leverage, now you just multiply
Yeah.
the numbers. So
Yep.
what was once a very profitable trade when you add tons of leverage has quickly become unprofitable
Yeah.
and getting more unprofitable every day that passes.
Okay.
Hence the need for those banks to unwind those hedge fund positions by selling all the collateral that they could find, which happened to be mostly US based securities.
Yeah. That's
How
great.
about that?
Yeah. Thank you for going through that
How
because,
about that?
again, I don't think that this is what a lot of investors are perceiving to be the cause. And so before we finish the economy and the policy, we did want to highlight everyone as well on a couple of economic indicators that we keep an eye on.
Yeah, so here's the Fed's playbook, right? They're so data dependent. They list out the data and they say, look, we're going to do what this chart tells us to do. The problem that many of us have had, certainly us, Julina, is we felt like the Fed wasn't looking at their own playbook. They say, well, the data will take us wherever it needs to take us. It's like, well, the data's there. You just haven't made the decision yet,
Yeah.
right? The data has been flashing. It's time to cut rates through our lens for at least a quarter. But if we used forward-looking guidance, if we assume, you know,
Yeah.
how the data is slowing and what that's going to result as, we were saying this at the end of last year, saying, hey, great. The Fed in December said it's time to maybe change position. We're thinking about pivoting, which was a great setup for maybe March, maybe June, maybe again in July. But no, they
No.
waited. And now you hear things like they're not going to cut by a quarter. It might be 50 basis points or 75 basis points. Well, that's what happens when the bond market takes over and tells you what to do. And that's what happens when the market no longer trusts your policy or your words. And that's what happens when you make a policy mistake. Now the market, capital markets, the bond market, now they want and need more.
Yeah.
And I believe they're going to get it. So come September, I'm thinking we see 50 basis points to 75 basis points cut right off the top.
Yeah.
And again, we were talking about they should be proactive here. They're going to have to be reactive, like they always are.
Right.
So, again, why do we have these 10-year cycles? It could very well be because the Fed goes from policy mistake to policy mistake. And then, there's just a long time frame for them to play out. Here's a perfect example of it. It is what it is. We're going to have a rate cut coming in, 60 days. One thing we should point out, we'll point out in two more charts, is there's something else being priced in, which really proves the fact that you've lost control of the narrative. So, with that, I will be quiet.
Well, we appreciate your candidness and your insight because, again, our hope through these educational webinars is to share with you some ideas that you may not be hearing from the mass media, and in hopes that you can control your emotions around the investing process because we know it gets emotional, and certainly this is one of those times. So we appreciate that.
Yeah, one thing I didn't mention, I'll close with this, is the summer months, the markets experience the least amount of volume all year, right? So these are more thinly traded markets because a lot of the quantitative traders and their controllers, the people, go on vacation. July is usually a low volume month. August is the lowest volume month. So if there's any turbulence that happens in the market, it is it is seen more. The spreads between prices are bigger. The movement in the markets is greater. And historically, when you look at the calendar, August is usually a negative month. A lot of it has to do with the illiquidity of the market for the month of August. So we'll leave it at that. We're still in a bull market. We believe we will be for years to come. We believe the positive things keep stacking up, like the Fed's really going to cut rates, and it's probably going to be by more soon. Earnings keep growing. The market is now on sale, right? If you thought it was expensive a few weeks ago, it's cheap now. There's a ton of cash on the sidelines. The yield on cash is set to decline, so it's very likely more of that money will find its way into the stock and bond market. So, great foundation for a very successful investing environment on the horizon here. Sort of a continuation of what we've had for the past 2 years will very likely be seen for the next handful of years. So, a lot to
Absolutely.
be optimistic for, and we're looking forward to it.
Yep. No, I appreciate that. And as we began this webinar and talked about, there are still some key decisions out there that need to be made. And so we know those are coming forward in the next few months, but certainly feel free to reach out to any of us here at Principal Wealth. In the meantime, if you have any concerns, questions, we're here for you. So thank you,
Great.
Bob.
Yeah, thank you.